Hello and welcome back to Swing Trading Bootcamp by Wealthy Education. In this video, we're going to talk about identifying overbought and oversold conditions using RSI and Stochastic. So the RSI, the relative strength indicator, is a window that goes at the bottom of your chart and it measures momentum and relative strength. I'll go ahead and put this on the chart. Relative strength index. And you can see that there's a band between 30 and 70 of purple, and that is considered normalcy. When we break above, it's overbought, and below, it's oversold. Quite simple. And you can see that we have, in fact, seen the market pull back from overbought conditions, break back down, got slightly oversold, kind of came back, slightly oversold, kind of came back, and then slightly oversold would kind of come back from there. You will see this occur time and time again on multiple time frames, but when you see the indicator jump up quite drastically, it can be a sign to sell, like in the overbought condition, or a sign to buy in the oversold condition, especially when you get at extremes. But what happens if you're already long of this market? This just gives you a heads up that you might want to tighten your stops or take profit. The RSI is very common. You will see a lot of people talk about using it. In this chart, I'll go ahead and I will put the stochastic oscillator, and it's down in the bottom. So let me go ahead and pull that up. And you can see it's a pair of moving averages, and it has a band between 20 and 80, which are considered to be normal range. And this tends to function much better in a range-bound market. So like when you get a market going flat like this, and you can put in your EMA to kind of confirm that. And let's just go ahead and let's just say we're going to use a 20-day EMA. You can see that we did, in fact, kind of go sideways here, kind of curved, and then kind of died out. Well, at that point, then you have to start thinking, am I in a range? And most certainly it looked as if you were. Well, when the moving averages cross in the overbought or oversold area, that is a sign that we are more than likely going to go in the other direction. So you can see that was a little bit of a heads up that we were going to pull back. This was a little bit of a heads up that we were going to rally. This was a little bit of a heads up that we were going to pull back a bit. We slightly did, just barely. And then here as well. But you started to see that we started to lose some of the efficacy of the indicator as the slope of the moving average dropped. So it definitely is something that you should pay attention to in range-bound markets. A lot of short-term traders will use stochastics as well. They look for range-bound markets so that they can take advantage of these overbought conditions. Overbought, oversold, overbought, oversold. You can see how that worked quite nicely in this kind of trendless market. And again, the RSI is just simple. You sell it when it's overbought or take profit. And when it's oversold, you buy it or take profit on your short. Pretty straightforward indicators. They're very powerful with other tools, support and resistance mainly, as they give you an idea of momentum.